Warren Buffett has said that taxes are the single largest expense most Americans will ever pay over the course of their lives. And it was not until I sat down with my accountant in February of my second year of retirement and watched him circle a number on my tax return that I understood what that meant for a man living on a fixed income. My name is Vincent. I am 79 years old. And the 5 mistakes I am going to tell you about today are the ones I made or watched people close to me make in the years since I stopped working. Mistakes that handed money to the IRS that we did not have to hand over during the years when every dollar counts more than it ever did before. I spent 26 years as a certified public accountant in private practice in Georgia. I prepared tax returns for individuals, small businesses, estates, and retirees. I knew the tax code in a working sense that most people never need to know it. I had advised hundreds of clients over the years on exactly the kinds of retirement tax situations I am going to describe to you today. And I still made 2 of these 5 mistakes myself in my first years of retirement, which tells you something important, not about my competence, but about the specific way that knowledge you apply professionally to other people's situations does not always translate automatically into action when it is your own situation, your own comfort, your own habits of decades that need to change. I want to tell you about 5 tax mistakes that are very common among retirees, that are most acute in the first quarter of the year when tax season forces a reckoning with the previous year's decisions, and that are almost entirely preventable with the right information in hand before the decisions are made rather than after the return is filed. The first mistake is the one I see cause the most genuine shock in people who are encountering it for the first time, and it is a shock that should not exist because the rule has been in place since 1983, but it consistently exists because almost nobody explains it clearly to people approaching retirement. A portion of your Social Security benefits may be subject to federal income tax, and the threshold at which taxation begins is lower than most people expect and has not been adjusted for inflation since it was set over 40 years ago. Up to 50% of your Social Security benefits become taxable when your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefits, exceeds $25,000 for a single filer or $32,000 for a couple filing jointly. Up to 85% of your benefits become taxable when that combined income exceeds $34,000 for a single filer or $44,000 for a couple. I had a client named Raymond who called me in March of his first year of retirement, having just received his tax documents. He was 70 and had retired the previous year from a state government position with a modest pension, was collecting Social Security, and had begun taking small withdrawals from a traditional IRA to supplement his income. He called me because his tax bill was significantly larger than he had expected, and he could not understand why. When I looked at his numbers, the reason was immediately clear. His combined income crossed the 85% threshold, meaning that 85 cents of every dollar of his Social Security benefit was being counted as taxable income. He had not known this was possible. His retirement income felt modest to him as it was, and he had assumed that Social Security, money he had paid into his entire working life, was simply his to collect. The fact that it could become taxable had never been explained to him by the Social Security Administration, by his employer, or by anyone he had spoken to in the years approaching retirement. The correction for this mistake is not available after the fact for the tax year in question. What is available going forward is careful income management, understanding your combined income thresholds, managing IRA withdrawal amounts to stay below or within the 50% bracket rather than pushing into the 85% zone, and planning Roth conversions in low-income years specifically to reduce the taxable IRA balance that will drive combined income higher in future years. This is planning that must happen before the income is generated, not after the return is filed. The second mistake is one that costs retirees who are charitably inclined a specific and recoverable amount of money every single year, and it is recoverable because the opportunity resets annually, but only if you know it exists and act on it before December 31st. It is the Qualified Charitable Distribution, which the tax code allows for people who are 70 and a half or older and who own a traditional IRA. A QCD allows you to direct up to $105,000 per year, the 2024 and 2025 limit, adjusted periodically for inflation, directly from your IRA to a qualifying charitable organization, and that transfer counts toward your required minimum distribution for the year without the distributed amount appearing as taxable income on your return. The difference between taking an IRA distribution, paying income tax on it, and then writing a charitable check versus making a qualified charitable distribution directly to the same organization is the income tax on the distributed amount. For someone in the 22% federal bracket making a $10,000 charitable gift, the QCD saves $2,200 in federal taxes on that gift. For someone in the 24% bracket, it saves $2,400. And because the QCD amount does not appear in your adjusted gross income, it can also prevent the Social Security combined income calculation from crossing into a higher taxation bracket and can prevent or reduce IRMA Medicare premium surcharges, both of which are income threshold sensitive. I made a QCD error myself in my first year of retirement. I had intended to use QCDs for my charitable giving that year, and I simply did not execute them before the deadline. I made my charitable gifts by check in November, took my IRA distribution separately in December, and filed my return in February, having paid full income tax on the IRA distribution and having received no tax benefit beyond the standard charitable deduction, which, at my income level and given the standard deduction, provided less benefit than the QCD would have. The error cost me $1,140 in federal tax that year. The following year, I set a calendar reminder in October and executed the QCDs correctly. The mechanism is straightforward once you understand it. The only reason it fails people is that they do not know it exists, or they know it exists and leave it too late. The third mistake involves required minimum distributions, and it is one that carries a specific and substantial penalty for non-compliance that I want to describe clearly, because the fear of it occasionally causes the opposite problem. People who are so aware of the RMD requirement that they take their distribution in January of every year without considering whether the timing of that distribution serves their tax situation for the full year. The RMD must be taken by December 31st of each year, with one exception, which is that your very first RMD may be deferred until April 1st of the following year, though doing so means taking 2 RMDs in 1 year, which often creates a tax problem of its own. The mistake I see most often is not the failure to take the RMD, most people take it, but the failure to report it correctly or to think carefully about the tax withholding on the distribution. When your IRA custodian distributes your RMD, they will ask whether you want federal tax withheld and at what percentage. Many retirees either decline withholding entirely, assuming they will address it at filing time, or select a withholding percentage that is too low relative to their actual tax liability when all income sources are combined. The result is an unexpected tax bill in April and, if the underpayment is significant, an underpayment penalty on top of it. I watched this happen to my brother-in-law, Leonard, in his first year of RMDs. He had declined withholding on his IRA distribution because he was accustomed to receiving his pension and Social Security without much tax owing, and he had not accounted for the way the IRA distribution would interact with his other income to push him into a higher bracket and increase the taxable portion of his Social Security simultaneously. His April tax bill was $4,300. He had the money to pay it, but it was a shock he did not need and a penalty he paid because he had not requested adequate withholding in December. The correction is simple. Request withholding on your RMD at a rate that reflects your expected combined income tax liability for the full year, or make estimated quarterly tax payments if you prefer to manage it yourself. The fourth mistake is one that most retirees are aware of in a general sense, but systematically underutilize because of a threshold that feels high until you actually add up the numbers. Medical expenses that exceed 7.5% of your adjusted gross income are deductible on Schedule A, and for retirees whose health care costs are significant and whose income is fixed, this threshold is often reachable, but the deduction is only available if you itemize rather than take the standard deduction, and the decision about whether to itemize versus take the standard deduction requires actually adding up your potential itemized deductions to see which produces the better outcome. The expenses that qualify are broader than most people realize, not just doctor and hospital bills, but Medicare premiums, including Part B and Part D, Medigap supplement premiums, dental expenses, vision expenses, hearing aids and batteries, prescription costs, long-term care insurance premiums up to age-based limits, and certain home modifications made for medical reasons. For a retiree who paid significant dental costs, purchased hearing aids, and paid Medicare and Medigap premiums throughout the year, the total qualified medical expenses can be substantial, and once they exceed the 7.5% floor, the excess is fully deductible. In my third year of retirement, I had a year of elevated medical expenses, a dental procedure, new hearing aids, and an outpatient procedure that generated significant out-of-pocket costs after Medicare. My total qualified medical expenses for the year were $11,400. My adjusted gross income that year was $52,000. 7.5% of $52,000 is $3,900. The deductible amount, everything above the floor, was $7,500. I itemized that year, and the deduction reduced my taxable income by $7,500 relative to what it would have been if I had simply taken the standard deduction. The tax saving at my bracket was $1,700. I have tracked my medical expenses carefully every year since with a simple monthly total in a spreadsheet, because the decision about whether to itemize or take the standard deduction cannot be made correctly without those numbers in front of you. The fifth mistake is the one that is most easily corrected and most consistently overlooked, and it is the failure to adjust your tax withholding after your income situation changes in retirement. During your working years, your employer handled withholding through your W-4, and it adjusted automatically as your salary changed. In retirement, your income sources, Social Security, pension, IRA withdrawals, investment income, each have their own withholding mechanisms that must be actively managed by you rather than automatically adjusted by an employer. The mistake is not updating those mechanisms when your income situation changes, which in early retirement it changes frequently. In the first 3 years of retirement, most people's income picture shifts considerably. Social Security timing changes. RMDs begin at 73, Roth conversions add taxable income in specific years, a pension cost of living adjustment increases income, a part-time consulting arrangement ends. Each of these changes affects your tax liability, and if your withholding elections across your income sources are not updated to reflect the new reality, you will either overpay throughout the year and give the government an interest-free loan, or underpay and face a bill and potentially a penalty in April. I recommend reviewing your withholding elections every January, across Social Security using Form W-4V, across any pension using your plan's withholding form, and across IRA distributions using the withholding election with your custodian, and comparing the projected total withholding against your estimated tax liability for the coming year. This takes about an hour with last year's return in front of you. It eliminates surprises in April, and it ensures that the money staying in your account throughout the year is working for you rather than sitting in the Treasury. I am 79 years old. I spent 26 years as an accountant helping other people navigate the tax code, and I still made 2 of these 5 mistakes in my own retirement because the knowledge I had did not automatically translate into the habits I needed. The Social Security taxation threshold, the QCD opportunity, the RMD withholding calculation, the medical expense deduction, the withholding adjustment review, these are not complex. They are specific. They require attention at specific moments in the year, and they reward that attention with real and recoverable money. Warren Buffett's observation about taxes being the largest lifetime expense is as true in retirement as it was during the years you were earning. The difference in retirement is that your income is fixed and your margin for unnecessary loss is smaller. Every dollar you hand to the IRS that the tax code did not require you to hand over is a dollar that is gone permanently. The 5 mistakes I have described today are the 5 most common ways that retirees hand those dollars over unnecessarily, and every one of them is correctable before this April if you act on them now. You have time. The question is whether you use it.